Hi, everybody. Please give me a few moments and we will be on our way. Okay, apologies for the delay. I have to run some small errands. Now we're back and we are live. With today's webinar, we're going to cover the topic of technical analysis. More specifically, we're going to delve into the most basic technical indicators out there. Most specifically, we're going to look at moving averages, RSI, and Bollinger Bands, some of the most widely known technical indicators that traders use and apply to their charts in order to make much more informed decisions when it comes to a trading journey. So today, give me a few minutes, please, moments, not minutes, to set everything up. Okay, I think everything is running up correctly. So please, can you let me know whether you can hear me loud and clear, whether you can type in the chat, not in the QA box, in the chat. That would be nice to get a few confirmations and start the whole thing. Okay, daily. Now, since we are late, let's just begin. And when someone else joins, we're going to do a small recap. So again, webinar, technical analysis, more specifically technical indicators. This is what we're going to talk about today. Basics, so fear not, this is a brief introduction. And as we go throughout down the line of this series, we're going to add more complexity to our lectures. Not lectures, but yeah, webinars. Okay. So I see people joining in still. Hi, guys. Again, apologies for the slight delay. We will begin actually right now. Okay. So you can type any sort of question, any inquiry you have in the chat box. If I'm talking too fast, if I'm going off topic, if you do not understand something that I've outlaid throughout the series, these webinars, sorry, excuse me, please feel free to type your question in the chat box and hopefully I'm going to address it in due time. So let me get up the Q&A box as well. Okay, so the one whatever you prefer, either in the Q&A or the chat box, let me know. So let's just begin. So technical analysis, introduction to technical indicators. We're going to cover 3 super basics. And as we go down the line of this webinar series, we're going to look at them much more closely, if you will like. So this is a quick risk warning and a disclaimer. I'm not going to go over this. You can read this at your own time. Basically, the gist of it is that we do not provide any sort of investment advice or investment recommendation throughout this webinar or webinars. This is purely for educational purposes only. Enough about this. Let's get started. What we will go over in this session. So introduction, a brief introduction to technical indicators. And we're going to look at moving averages, Bollinger Bands, RSI, and at the end of the day, as we go throughout these kind of topics, we're going to give you an introduction, an explanation of how to interpret them, which is at the end of the day what we are aiming for. Okay, understand how they work, and at the end of the day, understand what information are they conveying towards you and how to use it accordingly. So, intro to technical indicators. So in the prior webinar, we have outlined, if you look at the right-hand side of the chart, that I like specifically, this is not an official kind of split off. I like to split this big topic of technical analysis into 2 broad categories. Obviously, it does not encompass everything, but it encompasses the stuff that we will cover throughout this series. So split off is on the one side, you have charting analysis. On the other hand, we have mechanical analysis. We have outlined and outlaid the differences between the two and what goes where and what kind of information they convey. And a broad basic webinar we've covered in the past. At the end of the day, we have charting analysis, which uses bar charts, candlesticks, candlestick charts, trend lines, channels, support and resistance levels, chart patterns and gaps, and many others. And on the other side of the spectrum, we have mechanical analysis, which are most of the time technical indicators that have been computerized that to calculate information, they spit out something else, which is there's something else we're looking at, and hopefully we are using that information to make much more informed decisions. So you have under this category what we call moving averages, various numbers, many oscillators, envelopes and bands, and other technical indications. Today we're going to cover moving averages, RSI, and Bollinger Bands. All fall under the mechanical analysis category. On the prior webinar, we've done charting. So yeah, this is the topic of the day. So mechanical analysis, what is it? Is a branch that falls under technical analysis, which is the study of past price action. And in a sense, that's what technical analysts and traders do in order to come up with a lovely, hopefully accurate scenario on how to approach financial markets, more specifically any given instrument, and trade accordingly with that information that is provided by the various tools that they have at their disposal, which are falling under the categories of charting and mechanical analysis. Okay, so mechanical analysis more specifically is being performed by the use of moving averages, excuse me, oscillators, envelopes and bands, and many other technical indicators. And the aim of the technician is to establish the market sentiment. We should highlight this market sentiment. This is what we are after with mechanical tools or mechanical analysis in general, by the help of all those pre-mentioned tools. Okay, so technical analysis or chartists look for technical indicators in historical asset price data to judge entry and exit points for trades. At the end of the day, the gist of it is this: we use these technical indicators to and once we observe them and understand them and interpret them correctly, they give us signals on when to enter and when to exit, if you know how to do that. This is what we aim to do throughout the series. Anyways, okay, so that's why we use mechanical analysis, more specifically technical indicators, more specifically in general. So there are several technical indicators that fall broadly into two main categories. We have overlays. As the name suggests, they go on top of the chart, and oscillators. Okay, so you can look at them as a fluctuations of something. Something might be sentiment, something may be momentum, something may be buying strength or selling strength, whatever that is. These are oscillators. Overlays go on top of price action, so it's going to it's going to overlay the price action, whereas oscillators usually, I mean, 99% of the time, 98% of the time, they go on a different window below the price action. Okay, you can see, you're going to see some visual illustrations down the line. So technical indicators are also known as technicals, plain technicals, are focused on trading data such as price, volume, and open interest. Okay, these are the three main key pillars of technical analysis in general. Okay, these are the main categories that information is conveyed. This is the most crucial aspects that technical analysts look at when they do technical analysis. Price is the foremost and most important of the three, followed up by volume, which is supplementary, but also open interest is also important, but at the end of the day, supplementary towards price action. So you have definitely first thing you look at, which in terms of how strong or how grave or how important that data is price, followed up by volume, and then by open interest. Okay, so all three are important. You need to look at all these three parameters via the use of various numerous tools that we have available at our disposal in order to make much more informed decisions. That's the gist of it. Okay, so technical indicators are commonly used by active traders, but they're also used by long-term traders as well in order to keep up with how the trajectory of the or the formation of the patterns throughout the lifetime of their trade is doing. Okay, so they use various technical indicator tools, much less than short-term traders, we must say this, in order to get a gist of where the market is headed at, whether they are positioned according with the market, or whether it's time to close off a position and go the other way or adjust accordingly as the market behaves. Okay, so they use technical indicators as well, but primarily technical analysis, more specifically, these technical indicators are used primarily by the majority of traders who are in nature, by definition, short-term traders. Okay. Yeah, that's pretty much it. Moving on to the next slide. Again, we have types of technical analysis, and more specifically, we stay on the mechanical analysis aspect of things. We have on-chart indicators, which you may call overlays, and off-chart indicators, which we call oscillators. Okay, so on the left-hand side, on the on-chart, we have moving averages and Bollinger Bands, two of the things that we're going to talk about today. But also we have Ichimoku cloud, parabolic saw, Fibonacci, retracement, and expansion, extension tools, all that kind of lovely stuff. There is a lot of them out there. Unfortunately, we don't have enough time for every one of them. So we're going to cover moving average and Bollinger Bands, simplest, most easy, and most basic things you can apply to your charts after this kind of webinar if you're not familiar with them. Okay, super easy to understand compared to, for example, Ichimoku clouds. Which as a technical indicator needs a little bit more sophistication and knowledge from those that are actually using it. Super super important. It has a lot of great qualities that you can get great insights from, but it needs some sort of prior knowledge and a little bit more attention when you need to digest what kind of information is conveying. But still, we're going to do a webinar near the end of the series. We are on Ichimoku Cloud. So on off-chart indicators, we have what we call RSI, the relative strength index, moving average, convergence and divergence, or the MACD, the ADX, which is the average directional move, but also the broader based and simple momentum. Okay, so in this webinar, we're going to do two of on charts and one of the off charts kind of technical indicators, moving averages, Bollinger Bands, and RSI. MACD, we're going to do a special webinar down the line. ADX, same goes here. Super important and lovely indicators I like to use specifically when it comes to my job. Okay, so moving averages, let's start. So the moving average is, if not one of the most widely used technical indicators, because it identifies if a trend has already begun or an old trend has ended or reversed. Okay, notice the past tense here. That means moving averages are compiling information about the past. They are lagging indicators. They are telling you when, if that actually happened, when the market has shifted, okay, where it's going towards the upside and moves to the downside. You get this confirmation from moving averages. They do not have price predicting or future predicting abilities. Okay, they convey and compile information about the past. Do not treat this as a crystal ball that's going to tell you where the market is going to move towards the next. No, it compiles information about the past and it gives you the clear indication and highlights, in a sense, whether the current market trend has shifted or is actually going the same way. Okay, so it does not have future price predicting abilities. Please digest this. Do not treat moving averages as a leading kind of indicator. They do not tell you what the market is going to do next. Giving you an information, it gives you a snapshot of what has already happened. Okay, and you use that information accordingly. Okay, so it tracks the progress of a trend in a nutshell. That's what moving averages do. So it is the average of a certain body of data. So the 10-day uses the past 10 closings of closing prices of the past 10 days. It compiles them. So it adds all those values, those close prices of the past trading sessions together, and then divide that by 10 and you get the average. That's essentially what moving average means. Okay, so when we say this is the definition of average, when we use the term moving average, that means that period that you have priorly selected, let's just say 10, 20, 50, 100 days, whatever that is, or minutes, or 30 minutes, or whatever that is. Okay, it compiles information about that past period. So when a new day comes, okay, and imagine that today's session is over, moving average is going to be updated and it's going to use the close price of today's session and extract the now 11th session in the past. Okay, so it keeps track of the past 10 days, what has happened with close prices, and it averages it out. Okay, so you can clearly see from here that closing prices, okay, are the information that goes into this indicator. So it needs for the day to close. Therefore, you get the hint that this is not telling you anything about the future. It's telling you about what has already happened. Okay, so again, not a leading indicator. Do not treat it as such. It's crucial to digest this. Okay, so it is the average of a certain body of data. For example, if a 10-day average of closing prices is desired, the closing prices for the past 10 days are all added up and divided by 10. So the body of the data to be averaged moves forward with each new day. Therefore, you get the new day and you subtract the last day from those 10 periods. Okay, you create a new average and you move onwards. Okay, hence this is what gives you the term moving. Okay, so by averaging the price data, a smoother line is produced, which is much more clear to your eyes to say where the market is headed at. Okay, so it's a basic illustrative kind of tool, okay, that gives you clearly where the market is headed, whether it's moving upwards or downwards or sideways. Okay, you can confirm that with the moving average, and this is the primary purpose of these moving averages, to confirm where the market, where the trend is at currently right now. Okay, so a short-term moving average would hug price action much more closely than the longer-term one. Obviously, longer-term price and longer-term moving averages, they compile much more information, gives you a higher average most of the time, or lower depending where the market is going. And the greater the line, the greater the number of time periods used, the greater the smoothing. And you can look at the right-hand side where you have this kind of visual illustration. If you didn't have these annotations, which is 250, 10, 20, looking purely at these lines, this blue, this green, this red, and the black one, you could instantly guess which is which. I'm not talking about specific periods. I mean, I'm talking about in relative terms, which is the short-term moving average or the longer compared to the other one, which is longer. Okay, so smoother line, the 200-day, you can see that it's not fitting the price action much more closely, much like the 10-day moving average is. Okay, and in much more, not advanced, but more intermediate kind of terms, most traders, or the ones at least I've came across, like to use 2 moving averages or more to see whether it's going to be a short to medium kind of shift in trend, or whether that has happened, because using it only once gives you what you can clearly anyways see from the price action, from lower highs and lower lows in this kind of case. Okay, so you can see with the naked eye where the market is headed. Started from the top left-hand side corner of the chart and goes down to the right-hand side. Obviously, the market is moving in a downwards fashion. Okay, what we are attempting to do with 2 moving averages is see the interrelationship between a smooth line, a longer, a short line, and an SMA, a short moving average, and a long-term moving average, and how they behave. If you see crossovers, you see that the shift in trend from on the short-term high kind of horizon has been altered. So this is a very, very nice clue for you as a trader to digest from the beginning and see and take action upon it, actually, in your trading journey. Okay, so there are 3 types of moving averages. We call the simple moving average. Pretty much everyone uses this, but over the past few decades now, we have kind of moved towards the exponential moving average, which gives much more attention or weight on the nearest kind of periods. For example, if you have 10 periods, 10-day moving average, and you use an exponential moving average, much more weight on the price action in the calculation of the average is going to be placed on the day 10, 9, 8, and 7, something like this. Okay, so it depends on the setting you have in front of you. Okay, so the exponential moving average is much more jumpy, is much more accurate on the short term compared to the simple moving average, which purely adds all those 10 values and divides that by 10, or 20 numbers and divides it by 20. Okay, so yep, exponential moving average is another lovely example. Okay, so as the moving average is not a follower, it is a leader. Excuse me, it is a follower, but it's not a leader. That means it's not telling you where the market is going to move towards next. It's telling you what has already happened. So it follows the market, it signals that a trend has begun, but only after that has happened. Okay, doesn't tell you in advance what has happened or will happen, what has already happened. Okay, so we have two examples of strategies of moving averages. We're going to cover them in depth in upcoming webinars. This is for you to just save it for the time being, and hopefully going to join the webinar in the near future and watch it this in depth. But again, strategies by using moving averages, using only one moving average. When the market, the rules are when the market closes above the moving average, when you see a candle breaking above this kind of line, this is considered to be a bullish sign. And when you see the moving, the price action closing below the moving average, this is a bearish kind of, is treated like a bearish signal. Super simplistic, can work on many occasions. On other occasions, is kind of misleading. So you need to be aware of the shortfalls as well as the benefits. Okay, so two moving averages is a little bit more sophisticated, but again, at the end of the day, they are compiling information about the past. It gives you lovely insights, and the rationale behind this is, or the rules behind this is that when the short-term moving average is crossing above the long-term moving average, a bullish trend is signaled. So a bullish trend has begun. So imagine that a long-term moving average is coming down, where the short-term moving average line is crossing above it. That is telling you that on the short term, we have a shift in trend, and it's gonna alter the long-term kind of trajectory of that instrument, or has already altered the trajectory of the short-term instrument. It doesn't mean that it's going to move further north or to the sideways, it depends. Okay, but is treated as a bullish signal. Now, the opposite is also true. So when the short-term moving average crosses below the long-term one, a short position can be taken, yes, because this is a bearish kind of indication. Okay, going to see a visual illustration here. So the blue line, as you can guess by yourself, is the long-term moving average, because the green line at the end of the day is hugging the price action much more closer. So green line is the SMA, the short-term moving average, whereas the blue line is the LMA, the long-term moving average. Okay, you can clearly see that without knowing pretty much anything else. You don't need to know the periods that are studied. In this kind of occasion, if I'm not mistaken, this is 50 and 150. So it's a longer kind of perspective to see how the trends are shifting. So on this example here, we see the green line, the short-term moving average, crossing below the long-term moving average. So the green line is below the blue line, triggers a sell signal for us. So we will call a bearish crossover, or in other words, a death cross. And as you see from there onwards, the market has actually moved to lower ground. We see some sort of stabilization in here and down here, but then we see the green line crossing above the blue line, the longer term moving average, which is what we call a bullish crossover. That means there is a buy signal here. Once again, afterwards, we see a bearish crossover, green line below the blue, and once again, the green line above the blue. So again, overall, you can see the trajectory of this instrument, which is dollar yen, and it's past kind of quote unquote old example. You have seen the rally of the yen, of the dollar against the yen in this kind of case. So weakness of the yen and strength of the dollar pushed the pair to higher ground. But what you see is that this pair has bottomed down here, then was an intermediate or short-term kind of shift in trend confirmed by this breakout above this kind of level here. And from here onwards, you see the market moving north, the dollar yen as a pair moving north. Now, we're not going to go into details. Why has this came into fruition? We've Again, I've hinted to this in a few minutes back. Due to weakness of the yen and strength of the dollar, primarily due to the negative correlation or the wider the gap that was created by net interest differentials between the central bank of Japan and the Federal Reserve. So the Federal Reserve raised rates kind of drastically, whereas the Central Bank of Japan, the BOJ, has kept its policy rate, interest rates, unchanged at the same kind of period. That creates a difference between interest rates. So an economy or a country that its central bank is having higher interest rates compared to another economy, it creates this kind of volatile moves, and we're talking about big caps here, volatile moves in the FX market. So an economy that has a central bank that raises, for example, much like the Fed, the rates to 5%, whereas the Central Bank of Japan keeps them unchanged at a 0%, so 5% difference in interest rates. So net interest rate differential between the two countries is large. Flows of money go towards the dollar, okay, because you can park your money in the United States economy and get interest payable on this kind of policy regime that the central bank is creating. And you see the fleeing of capital, so they take money away from Japan and put it into the Japanese yen. So they sell the Japanese yen and they buy the dollar. This leads to this rapid appreciation. Okay, so enough about this. Moving on to the next. What's the time? 1:30, perfect. So next topic is Bollinger Bands. I don't know if you're familiar with this. Again, super simple concept, easy to understand and comprehend. You'll see what I mean right now. So Bollinger Bands, this was a technique that was created by John Bollinger back in the 1980s, if I'm not mistaken. So two bands are placed around a 20-day moving average. The 20 can be altered to whatever period you like, by the way. This is the default setting, okay? The 20-day moving average. It uses information about the prior slide we just made, moving average, and it adds two bands. So Bollinger Bands uses statistical data. More specifically, we're talking about standard deviation, which is a statistical concept that describes how prices are spread around an average value. So moving average is the average value, and you have the standard deviation, this statistical kind of tool, that adds on a buffer zone above this line and below this line in order to capture how far the price action is moving away from that average. Okay, this is in simple terms what the Bollinger Bands are doing. So in this kind of case, the upper band is the 20-day moving average, okay, which is updated daily, and you add on two standard deviations on top of it. This is mechanical, by the way. You are not going to manufacture this indicator by yourself on your own. It's already computerized. You just select the period and the software spits out the Bollinger Bands. And you have two standard deviations. Above the moving average is the upper bound, and the lower bound is moving average minus two standard deviations. Okay, so the reason why we use two standard deviations and not three and not one is because two standard deviations ensures that 95% of the price data is probably going to fall within the two bands. That means that volatile move between these kind of two bounds, yes, is kind of explained due to the higher volatility that arises, but it captures only the 95%. So the remaining 5% is what we do care about. So we're looking at, when we use the Bollinger Band, in a sense, we're looking for those volatile periods on an instrument's price action history that gives us signal that this move has moved way ahead of itself, and that correction near the average is probably going to ensue. Okay, you will see what I mean shortly. So Bollinger Bands measure volatility. Okay, this is what information they are conveying. These are compiling volatility of the instrument under study. Now, when the market becomes more volatile, okay, because of something of bad news coming up or good news coming up, and you see price action moving up and down with an erratic kind of manner. Bollinger Bands are actually widening as well, because once again it uses 20-day moving average, and as the days progress you add on these kind of volatile moves into the mix, and therefore the Bollinger Bands get adjusted. Okay, so the more volatile the price action is, the wider the bands will get. Okay, they adjust accordingly to the trading, to the volatility within the day. Whereas in periods where you see the Bollinger Bands narrowing, that means there is absence of volatility. Again, you can use these kind of interrelationships accordingly. So the closer the price move to the upper band, or the lower band in this kind of case, basically let's start with the upper band. So the closer the prices are to the upper bound, the more overbought the market is. That means that, you know what, the bulls are way too strong and the bears are pretty much eager to enter the picture and push prices to lower ground, assuming that we have this kind of prime rule in financial markets, which is the reversion towards the mean. When something goes way too far away from the average, most of the times the price action returns back towards the average value. Okay, this is a concept that was observed throughout many years in trading. Okay, so this is an unwritten rule. It doesn't mean that it's always there. It's not something that it is written in stone. It's just a basic clear-cut observation from traders throughout the years. Okay, so the reversion towards the mean. On the flip side, the closer the prices move to the lower band, excuse me, the more oversold the market is. Okay, and this sparks short-term deep buying opportunities, or at least the mentality, triggers the mentality of deep buyers, and therefore most of the times you see this correction following afterwards once you see the break above or below the price the bands. So upper and lower bands can also be used as price targets. We're going to go into the details here. Okay, so where the market is headed, clearly south, clearly downwards. Okay, you can clearly see that from the price action alone. So lower high, so this is the previous high, so lower high, and then you have a lower low, lower high. This is a comparison, lower low, lower high, lower high, lower low, lower low. So you see the peaks and troughs of this kind of instrument, clearly seeing where the market is headed. You can also use the moving average on the middle of it, the midline. This is the 20-day moving average to give you an indication where the market is headed if that is not clear for you. Okay, and you have an upper bound and a lower bound. Let me get a pen here and do the laser. Oh, there's the pen. So this is an area of interest for us when we use the Bollinger Band. By the way, upper bound of the Bollinger Band is this, lower bound of the Bollinger Band is this, midline is this. Okay, clearly see. And you can see the more volatile the price action, the larger the bands get. So you see this difference in distance from the midline here, and you can see that the distance between this is much smaller. So this area is low volatility, this area is high volatility. Okay, so what we're dealing with here is that whenever we see breaks above the upper bound of the Bollinger Band, we most of the times go short, assuming that price action is going to return towards the midline. Sometimes it goes way below, which is another scenario we see here. Break below triggers a buy opportunity, and you have a take profit somewhere in the midline as well. So that's pretty much how you treat Bollinger Bands. Okay, another opportunity arose here. Excessive short selling activity. Buyers enter the picture and push the price action to higher ground. Excuse me. Similar may be observed here. Buyers enter the picture, push the price action to higher ground. Also, the opposite is here. Slight break below the upper bound of the Bollinger Band follows correction. Okay, so this is an unwritten kind of rule in financial markets, the reversion towards the mean. Bollinger Bands is a lovely way to use this information. So Bollinger Bands is a technical analysis tool invented by John Bollinger back in the 1980s, having evolved from the concept of trading bands. Pretty much the same thing. Instead, however, trading bands are not dynamic, they are fixed. So it's a moving average plus 2% above, 2% below, or 5% on 5%, whatever that is. Bollinger Bands are much more dynamic in rate, in nature, because they adjust according to volatility, whereas fixed bands do not. So Bollinger Bands are indeed superior to fixed bands, or trading bands, in other words. Okay, so Bollinger Bands can be used to measure the highness or the lowness of the price relative to previous trades. So Bollinger Bands consist of a middle band, the midline, upper and lower, okay, which is the moving average, the midline. This is the standard deviation. The K most of the time is 2. So it's a moving average plus 2 standard deviations for the upper band, and the lower band is moving average minus 2 standard deviations. Okay, so the default choice of the average is a simple moving average, but other type of averages can be employed and needed. Exponential is another viable alternative, and is actually gaining momentum in recent years because EMA, the exponential moving average, is most sensitive to price movements compared to the simple moving average, at least the latest one. Okay, RSI, let's move on to the next topic. So overview of the RSI, the Relative Strength Index. So Relative Strength Index is a technical indicator used in technical analysis of financial markets. So is intended to chart the current and historical strength or weakness of an instrument. Okay, so we're talking about strength of a move based on the closing prices of a recent trading period. Okay, so this is a momentum oscillator, one of the most widely known and used ones, okay, which is measuring the velocity, how fast and how strong the direction of price movements are. Okay, so a super important technical indicator that is an oscillator that goes below or below the chart on your setup, that can give you lovely insights on how to trade. Okay, so we're going to talk about specifically in the next few webinars about RSI divergences, something I really like to spot and look forward to, because they're, relatively speaking, super easy to understand and spot, but also to trade. Okay, so you see build up of momentum, you see some sort of slack coming into fruition, price action continues to move higher, but RSI is giving you indications that, you know what, there is not much more momentum left in this kind of trade. From there onwards, you extrapolate that a correction is going to take place and you capitalize upon this by going short. Okay, let's not go into many more details because we're going to see it in future webinars. So momentum. What is momentum? Is the rate of rise or falling of prices. Okay, that's what momentum is. Momentum is a simple technical indicator. So RSI is an adjusted momentum oscillator that takes into account many other things to give you an indication of how strong or weak the trajectory of this kind of momentum of an instrument is currently or historically. Okay, so RSI computes momentum as the ratio, okay, of higher closes to lower closes. Okay, so in general, instruments that do have more positive changes because they have stronger closes tend to lead to higher RSI numbers compared to an instrument that has lower closes over a significant amount of time, which breaks down the number of the RSI, signaling that there is strong negative kind of momentum or strong negative chances or changes around that instrument. Okay, so RSI is most typically used on a 14-day time frame. Again, this can be adjusted accordingly to get the cyclicality of markets. For example, commodities, you can do that as a 21, super important as well. So monthly kind of life cycle in futures, pretty much the same thing can be used as well in order to get much more accuracy in your trades. Okay, so measured on a scale from 0 to 100. So 0 is extreme negative momentum, 100 is extreme bullish momentum. So rough to see these kind of numbers. Most you can have seen best personal is 93 and 94 on some super small cap but super volatile instruments. And pretty much most of the times we see the price action, or the RSI, excuse me, fluctuating between something like 30 and 70. Okay, so which are in a sense the crucial levels. Okay, you're gonna see them on shorter or longer time frames. You can alter this kind of bands. The A 70 and 13 can become an 80 and 20, so you give much more leeway in regards to your classification of how extreme a move is by notching it up to the 70, and from 70 to 80. In a sense, you get much more more volatile moves because you widen the bands, the area that you see critical, and you allow much more volatility to be shown on your RSI indicator, and you act accordingly. Or you can do 90 and 10, which is super rare. Not rare, but it's not as is not as common as the 70 and 30 or the 80 and 20. But still, if you get a value above the 90 kind of mark, you're definitely sure that bullish momentum is superbly strong, and maybe a correction for lower is gonna follow. Okay, same thing goes, the opposite thing goes to say for the 10 as well. Okay, so visualization of relative strength index. What is the instrument? Dollar yen. Once again, you see Bollinger Bands and RSI below once again. Okay, you can clearly see the mark this instrument excuse me, dollar yen fluctuating between the 70 and the 30 in a nice manner. Okay, around the 50 as well. And for some reason, we discussed the reason beforehand, we see this rally of RSI giving you an excuse me, an indication that a strong bullish momentum currently is probably going to push price action to higher ground. Most of the times, all the times basically, RSI also compiles information about the past. No leading indicators. This is not a leading indicator in any sort of way. It's much more jumpy or more volatile or more accurate on short-term kind of scenarios. RSI gives you instant kind of hints, but at the end of the day, it's also a lagging indicator because it compiles information about the past 14, 21, whatever days you have selected. Afterwards, you see this, if you use the 50 as your guideline, so it's the area between expansion and contraction territory, if you will like, or bullish and bearish kind of momentum. So above 50, that means the bulls are in control. Below 50, that means that the sellers are in control. So we went from a period of sellers being in control, okay, not by too much, but then you see a break above the 50 and the bulls taking the initiative, okay. This is a lovely indication that tells you the bulls have now taken control, confirmed also by the moving average, confirmed also by the Bollinger Bands, okay. So add all those things together, you get a bullish signal that you can trade on. And afterwards, you see RSI staying above the 50 line. That means the bulls are in control and still in control. And then once again, push the price action above the 70, which is over bought kind of territory. You see contraction once again above the 50, 1, 2, 3 times. And then once again, you see a surge of RSI that hits maybe somewhere around the 85 to 90 kind of area. So superbly strong bullish sentiment. You can clearly see that obviously from price action. Okay, albeit it's few corrections. Main trajectory is obviously upside. Okay, here, and the RSI confirms that. Okay. So the principles of RSI and the conditions, let's go cover them pretty quickly. So because we're running out of time. So the principles are when the price moves up very rapidly at some point in time is considered to be overbought. So above 70 is overbought or above 80 is overbought. So likewise, the price falls very rapidly at some point is considered to be oversold. So overbought, most traders go short if they do have enough conviction and enough signal. And when it reaches oversold conditions, you see deep buying activity, traders going along to capitalize upon the expectation that there's going to be a reversion toward the mean because the move has been super excessive. So the level of the RSI is, this gives the rise for the potential reversal scenario. And this was what we are attempting to capitalize upon when we use the RSI. Okay, so analysts look for these levels. The level of the RSI is a measure of the stock's recent trading strength. Remember, it's a lagging indicator like a moving average. Use moving average as well. And it's not forward-looking. No information about the future whatsoever. So the slope of the RSI is directly proportional to the velocity of the changing trend. So the sharper the slope is, much like in this kind of fashion, when vertical, same thing here, signifies superbly strong bullish sentiment. And this is what we are looking forward to. Same thing goes here. Look at how it picked up compared to this, which is kind of flatlining. Okay. So velocity matters and is something that we pay close attention to. So the distance traveled by the RSI is proportional to the magnitude of the move. So if you jump from the 50 towards the 60 and the 60 towards the 70, and you have a sharp slope as well, magnitude and velocity are there. Super nice signals that tell you go long. Okay, so it's believed that tops and bottoms are indicated when the RSI goes above 70 and below 30, which is another way of conceptualizing this market has moved and reached peaks and troughs in this kind of example. Above 70, this is going to be a peak. Below 30 is a trough. Traditionally, RSI readings greater than the 70 level are considered to be overbought, and RSI readings below the 30 are considered oversold territory. So in between the 30 and 70, the bands, or the 80 and 20, we see this as a neutral kind of area, with the 50 being the primary example of a computerized signal of indecision, so no trend. Okay, when you see markets or instruments fluctuating around 50, most of the times with an RSI value of 50, most of the times they are not going anywhere. Okay, you can use that information accordingly. So overbought and oversold conditions. Now, analysts consider that failure swings above the 70 and 30 on the RSI are strong indications of market reversals. You'll see what I mean by this. And we see an example, RSI hits a 76 level, goes back to 72, and then rises to 77. So it does something like, assume this is the 70 line, this is the 50 line. So 70 is this. So it goes up, comes down, and then does this. Okay. Analysts would consider to this be a failure swing above 50. So you would have expected it to move this way, but it failed to do so and swung upwards. So this is a failed kind of swing, this one. Okay, so you treat this accordingly most of the times with going long. So finally, chart formations or in areas of support and resistance could sometimes be more easily seen on the RSI chart compared to the price chart. Now, the center line of the relative strength index is 50, which is often seen as both support and resistance line for the indicator. If the relative strength index is above the 50, it generally means that the trading instruments losses are greater Down the gains, when the relative strength index is above 50, it generally means that the gains are greater than the losses. Obviously, because you use closing prices. So if you have a streak of closing prices higher than the average, obviously you will get a higher RSI value. Okay, so below 50, it means that losses are greater than the gains. That means the bears are in control. Above 50, generally means that gains are greater than the losses. The bulls are in control. Okay, fear not, we will see them, those three, much more in depth going forward. For the time being, I don't see any sort of questions coming through. I'm gonna leave this here and finish the session. Yep, few minutes before close. So thanks for watching, guys, and we hopefully gonna catch you on the next webinar. I'm not sure where it's gonna be. Probably not next week. In a few weeks time, because we're going on holidays. Okay, so for the time being, take care, bye, and yep, hopefully we'll catch you on a future webinar. Okay, ciao.